So I was asked to talk a little bit about my experience as an angel investor and investor in Toys R Us. I am the main shareholder of Toys R Us Iberia in Portugal and Spain. We bought it from the Toys R Us in the US 2 years ago, and we are changing it in Portugal and Spain, and I can share some information with you, but also to talk a little bit about how I see the startups when they approach these companies like our company, like Toys R Us. And I see a lot of problems there, and the entrepreneurs, I think, do not approach correctly these companies. I have been trying to help a lot of startups to sell products in our stores. And I can tell you that 90% of them fail to provide minimum conditions for us to sell in these stores. They don't understand what we are looking for, and what they need to do as well. For instance, companies that do not have a translation of their products or their instructions to Portuguese and Spanish, for instance, we cannot sell these products. So asking us to do these translations, it does make sense for us. So it's better that they need to prepare for these translations. I have a short presentation so that where I can share some of my experience. So let me see.
While you're getting your presentation out, I can tell you that pop guitar are Chinese guitar and ukulele. I remember speaking with them, and they were like, "Oh no, then we will have to have call centers and stuff in English. It's so much easier just to keep it in one language." But they are now over that and past that. Sorry for interrupting.
No, well, for instance, I tell entrepreneurs many times, why don't you do instructions without any words? Just put some drawings, and then it works for all the countries, you know. And some people say, "Oh wow, I never thought about it." So I think it's a good way. It doesn't solve 100%, but it can solve a little bit of the problem. So do you see my screen? Yes. Okay. So we in Toys R Us Iberia, we have sales of 142 million euros revenue per year. We have 59 large stores in Portugal and Spain, and we have more than 3 million registered clients in our databases and with our card. And we have more than 1,000 people as staff. We have 14% of the toy market share in Portugal and Spain. You can see where we are based. Mainly, it's where are more people, of course, and the main cities in Portugal and Spain. We have, since we bought Toys R Us in Portugal and Spain, we started a change in the stores, and we decided that our motto would be, "It is forbidden not to touch." Of course, now with COVID, this is a little bit not possible, but we wanted people to go into our stores, to play, to learn, to touch, and then to buy, of course. And this is being very successful. You see, for instance, one example of one of our stores before and after we change. So when we bring play, learn, activity, interaction into the stores, people love them, and they buy more things there as well. We also organize birthdays, competitions, workshops, and the product demonstrations, and this is also an income for us, and which was not there before. So now talking a little bit about why investors do not invest in startups. I see, as you know, Rasmus, I've been an investor for many years, and I'm still an investor. I have a portfolio of around 11 companies. One of them is Toys R Us. And where I see the big problem is that the entrepreneurs focus on themselves and try to focus on the potential of the project or the idea, but they don't think why the investors do not invest. Only between 1 to 3% of the projects that are introduced to investors receive funding from them. So why is it so low? So there are two studies that I strongly recommend any entrepreneur and any investor, of course, to also have a look. One is why business angels do not invest in some projects, and the other one is on the CB Insights in US, the top reasons why startups fail. And for those that are not so aware of this market related with investors, they can be surprised with the answers. And the main reason, 87% why investors didn't invest in some deals is because the project had too many risks. If we ask this question to in normal people that are not investors, they would say because the project has no potential. But if you see here, only 7% of the projects didn't have enough return for the investor, so they didn't have enough potential. So this means that 93% of the projects, if they really happen, then the investor would be very happy and he would be able to invest. But because the investor is afraid of the execution, because everything is related with the execution, then he doesn't invest. The second reason is about the valuation. And this is one of the biggest problems I see in the market, because some entrepreneurs hire some experts, some consultants, some investment banks that create very good valuations, very nice, beautiful presented, but in the end is about the future that we are talking. And when I receive a valuation from a startup, very well done, I ask the startup where the people that did this valuation, to ask them if they know any company 5 years ago that pitched 5 years ago and the project really happened exactly how was in the business plan. Because of course this does not happen. So we need to understand that all business plans are wrong. They will not happen. They can be better or they can be worse in the future, but they will not happen. So how can we, with wrong data, have a miracle process that brings a fantastic valuation? This does not happen in real world, but entrepreneurs get these valuations and then they get they don't move very much in terms of these valuations, and then investors do not invest as well. So there is a need of teaching entrepreneurs how to approach investors concerning this process of valuation as well. Then another question that of course was asked is, if the project risks are reduced, your willingness to invest increases, and 96% of the investors said yes, it will increase. So what is important is to understand why and which entities can fund the business and why this is relevant. So here in this chart that I did this chart, so I also did some play and help to learn as well. The probability of an entrepreneur to raise money for his venture or her venture. And on the other side, we have the mitigated risks. In terms of the mitigated risks, what are the main risks in any business? The market, if there is a market for the project, how is the competition to react? Then the team, the entrepreneur, then the legal risk, if it's legal, do you have the license? Are you infringing any patent? Then the financial risk, are you dependent on one client? Are you dependent on funding from a bank? And then we have the operational risk. Do you know how to do it? This is what you want to do. Is it the first time or not? So why is this relevant? Because there is some entities that usually entrepreneurs say very, very bad things about them, is called the banks. These banks, the banks only accept a very little risk. If the project has a lot of risk, the banks will not invest, it will not give the loan. Then the entrepreneurs need to go to mutual guarantees, which is the entities that will give a guarantee to the banks in case of default from the entrepreneur. And if there is more risk in this process, then the entrepreneurs need to go to the venture capitalists, and then they need to go to the business angels, and then to the crowdfunding, and then of course to the ICOs, the initial coin offerings that is still popular in some parts of the world. From this point, the only thing that is possible for the entrepreneurs is to raise money from family, from friends, from some people called fools, because there are always fools around the world. I never say that it's impossible for anyone to raise money for anything. and of course from the state. We see some states around the world giving grants to entrepreneurs, giving some funding loans to entrepreneurs that do not have any possibility of success. So, and why is this relevant? Because 95% of the projects that are presented to investors are on the left side of this chart. So they don't have any chance of getting money. And this is really important. So entrepreneur needs to do two things. One is to believe that the government will tell all these entities that they will need to accept more risk. And if the entrepreneur believes in this, then just relax, wait for the future will come. If you don't believe in this, then you need to mitigate the risk, to reduce these risks in order that your project can be funded by investors.
Paulo, here at the end, how are play and learn startups different? Are there greater risks because it's more difficult to assess whether something will be playful or whether the learning will take place, or how are they different?
I think I don't see any difference between play and learn companies and other companies, because you need to first do experiment and see if the people like, and if the people enjoy, and if the people are willing to pay, or the people or companies, whatever. So you need to do a kind of MVP and verify that there is a need for your product, and then you talk with clients. If you are trying to sell business to business and you approach an investor and you have never talked with a potential client, just forget, something is wrong with you. So you need to mitigate this risk in terms of the market. Another thing that is important is the real risk versus risk perception. Sometimes entrepreneurs think that investors know everything about the sector or know about the product, and they don't know. So you need also to reduce the risk perception. Of course, it's important to focus on the high impact and high probability risks and not on the other ones. And in some countries, there are tax breaks and other ways to reduce the investment risk. So for entrepreneurs that, for instance, in UK, Malaysia, and other countries around the world, Turkey, for instance, I was before a speaker before me, you can also focus approaching the investor with these tax breaks for the investor, and this reduces their own risk, the investment risk. So finally, what you need to do is to identify these risks that and reduce them and increase a bit your own risk as well, so that the investor sees that there is some skin in the game and not something like I will just get the money from investors, and if the company is successful, I will be a millionaire. If the company is not successful, the investors lose the money, I do something else. So this kind of mentality does not help to fundraise. And so instead of 80% trying to fundraise and 20% mitigating the risk, it should be the opposite. 80% mitigating the risks and 20% then fundraising, because it will be much easier. So after you identify, you need to level to understand which risks are the more impactful and with higher probability. And then for each of these risks, you need to eliminate, reduce, transfer, or accept. And you need to continue this process. And I hope that I have given some examples of what I think that the entrepreneurs need to do in terms of being more successful fundraising.
That was